Joining me now is Mike Lawrenson of Lawrenson Capital, and we'll be discussing the Nedgroup Investments SA Equity Fund. The fund has delivered annualized returns ahead of the benchmark since inception through a nimble process of combining top-down macro considerations and bottom-up stock picking. Mike, let's start with the market backdrop. The FTSE Cap Swiss All Share Index is down 2.8% more or less year to date, but there's been quite a bit of divergence beneath the surface. What do you make of that?
The performance is almost the opposite of what we saw last year. So at the beginning of the year, we saw a strong performance from the resources, particularly gold and platinum counters. And in the second half, the second quarter, we've seen a reversal of that strong performance, particularly after the start of the Iranian war. At the same time, we've seen strong performance from telcos, which is a continuation of what we saw last year. And then banks actually had a pretty strong second quarter as well, ending the half up quite strongly. So yeah, it very much a different second quarter versus the first quarter, but some of the themes are a continuation from the prior year.
And then if you zoom out a bit, looking at the 12-month view, that view then changes a bit. If investors have missed last year's move in markets, particularly local markets, where do you still see the most compelling opportunities? Where's that set today sitting at?
So if I look at the market in general, or the South African domestic market, we see banks. We added to our banking position during the year. We still think that many of these banks are on 6-7 multiples on dividend yields of sort of 6 to 9%. So we still think there's upside there. I mean, the one worth talking about is FirstRand. Obviously, they've resolved that issue with mis-selling of vehicle finance in the UK. There's also speculation, not speculation, they've actually confirmed that Aldermore is for sale. And on our analysis, if they're successful in getting close to NAV for that business, we see ROEs increasing from around about 20% to 25%. So we think that's a positive. We added to ABSA in the period, and we also added to Capitec. Other areas where we see value, we still think Tencent through Naspers and Process offers value. It's trading at a 13 times PE, which is close to its all-time lows. We like their AI opportunities within their strong customer base. So we think the market isn't giving them credit, and the discount is sort of in the mid to high 30s. So we like Process there. And then in the gold mining space, we've seen quite a big correction. Gold's around about $4,000. We believe that the fundamentals for gold still prevail. It's performed more pro-cyclical or pro-risk more recently rather than the defensive element. But clearly, with heightened inflation concerns and potential global interest rate rises around the world, that will, in the short term, put pressure on the gold price. And then in the diversified space, we still happy holders of copper. Particularly, we like copper. We like the long-term prospects of it. The supply side is very constrained, and we think that the longer-term demand growth prospects are good. So, we like in that space, we like Anglos and Glencore. We did add to Anglos during the period, and at the margin, we sold some Glencore that was more on valuation grounds and price performance. It's had actually quite a strong year. So those would be the key issues, or where we see opportunity. And then in some of the global cyclical consumer stocks, we like AB InBev. We continue to like that. That's had a strong period. We actually did a gain on price performance. We actually reduced exposure a little bit, and then we've added to Bidcorp during the period. We've added to Mr. Price, and maybe we can discuss that later. So I'll stop there for now.
Yeah. Using this period basically, of dislocation or down markets to actually find those opportunities.
Exactly.
Yeah.
Exactly.
Maybe with that background in mind, maybe just walk us through fund performance for the last, let's say, quarter and year to date.
Okay, so if we look at the year to date, the fund is down 4.8% for the period. We've underperformed against the index and against peers. I mean, I can attribute it basically to 3 or 4 stocks. So the one is MTN. We own very little MTN, and clearly in hindsight we've been wrong on that. Obviously the growth prospects in Ghana and Nigeria have surprised to the upside. We continue to reassess that position, but at this stage we think it's probably fairly valued. So at this stage we haven't changed our view on that. Then Naspers process, that's been unfortunately been a significant detractor of performance, and largely on the underperformance of Tencent, where we believe that the market's not appreciating the AI potential in that business. And then Foschini Group, in terms of a 1-year return, has also impacted us. And then not owning Capitec are probably the 4 stocks worth highlighting on the underperformance side. On the positive side, Anglo Gold, Anheuser-Busch, First Rand, etc., have been the contributors to performance. And then longer term, if we go further out to our sort of 3-year and 5-year, lagging the index, but the index has been quite narrow and broadly in line to ahead of the peers, 3, 5-year and since inception. And then what is quite nice is the consistency that we've achieved in terms of rolling 3-year and 5-year periods, where we've sort of 2/3 of the time ahead of benchmark and ahead of peers.
Yeah, I do want to pick up on that point. I find that quite interesting, that consistency that comes through. What has been the key driver behind that consistency in that rolling sort of return profile?
Look, it's difficult to pinpoint exactly, but I think it's the fact that we bottom up analysts. Everything's done on a stock basis, bottom up research, and we get to a fair value, and we're quite stringent in applying those fair values. So I think it's more that approach than maybe being momentum driven, etc. So I think that is when you have a line in the sand in terms of a valuation, I think an example is Discovery. We bought Discovery probably 18 months ago. It had a strong year. I think it was up close to 25% in the first half of the year, and that is one stock we've actually sold out of entirely, and that was purely on our assessment of fair value. And that stock that holding we switched into OUTsurance. So I think that is probably the key driver is that line in the sand in terms of assessing fair value.
Yeah, not basically overpaying for stocks and chasing at any value.
Exactly. And in the other one I highlighted earlier was MTN. We think it's close to fair value. So do we now at fair value go and close a bet that is that clearly we got wrong in hindsight? But I think it's that discipline.
Yeah, and if we look at the attribution for the last quarter, is there anything perhaps that you missed, maybe from an underweight perspective besides MTN?
From an underweight perspective, I guess, are you talking for the year to date? Sorry, I haven't got a quarter to date slide, but from an underweight perspective would have been Standard Bank, definitely. But again, that's on valuation grounds. We sold out of Standard Bank during the quarter purely on valuation grounds, and we've switched that into a combination of First Rand, ABSA and Capitec. Another underweight clearly was the MTN, which I mentioned, and then BHP. But overall, we've in the diversified mining space, our holdings in both Anglos and Glencore have more than offset the underperformance by not holding BHP. And again, there it's our view on copper. While BHP does own copper, we are concerned around the quantum of the iron ore exposure within BHP, and while they are the lowest cost producer, we are worried about iron ore prices in the medium term, as one, China steel production plateaus, and two, there is new supply coming out of Guinea, and Simandou is the new mine, and that so that's primarily our reason. So BHP owns copper, but within Glencore and Anglo's, you get probably better copper exposure in terms of the overall mix.
A bit of a higher quality mix, you'd say?
Not necessarily higher quality, but more copper in the overall mix, and probably in the short to medium term, better copper growth prospects. BHP does have copper growth projects, but they're more long dated, and they're probably only going to come to fruition in 2030 plus, and at a big capital cost. Whereas Glencore and Anglo's are probably less capital intensive.
Okay, moving a bit to the bigger picture now. Over the last year, we've had a good rally in SA stocks. South Africa still screens one of the cheapest globally. Why do you think global investors still remain hesitant on SA?
So I guess just to provide some context, first of all, on your comment about screening cheaply. I mean, if you look at that slide, you can see that the South African market, despite having a better second quarter, it's actually derated from the lows of March, post-war, whereas most other markets have rallied from those levels. So I guess, in assessing the question that you posed, there are a couple of things that South Africans or South African markets still face. We've got an election coming up, which is next year, so there are obviously some concerns about that. And then, growth itself, we just not seeing the growth. There are signs of growth, but we just not being able to sort of bring it home, if I can say it as that. But the signs are positive. So I think it's the broader market participants are questioning SA growth, I think, for one, and then at the same time, from a South African stock market point of view, is that we are quite heavily resource based, and the correction in both gold and PGMs has obviously influenced the stock market return. But if I was to exclude the commodity component, I think SA Inc. does offer good value opportunities, and there are some stocks we really like in that space, and we can maybe touch on them later.
Yeah, we'll come back to that a bit later. If we look at maybe bonds compared to equities, certainly bonds seems to be pricing a lot of good news. Like if we look at the rally that we've seen in bonds, there's certainly be a divergence, and I know we've spoken about this before, between bond valuations and equity valuations. Which market do you believe is correct?
Look, I think my view is the bond yields are probably more correct. I think our Reserve Bank, has managed the fiscus very well, and I think that it's the slide where you look at the potential fiscus proceeds coming from corporate tax from the mining sector and royalties from the mining sector, and if you look at both of those, they're up quite strongly on FY25. Yes, we're not back at the levels seen in 21, but I guess the point I'm trying to make is that despite the correction in commodity prices, at spot levels where those charts were run, the contributions from those higher commodity prices are still great, and that is supportive of the SA fiscus, and it should, at the margin, be good for SA growth, because the miners will be getting bigger bonuses, etc., and that should have a secondary impact on the global economy. So, I think bond yields are correct. I think it's the PE that is wrong, but I think part of the concern around the PE is the fact that we're just not getting the growth, and I guess the market is waiting for signs of growth. But we are positive on the short to medium term outlook.
Yeah, speaking of miners, I can't not chat to you, seeing as you're one of the most experienced resource analysts in the SA market. Gold miners have been a major contributor, over the past year. You've had some stocks in the fund. We've seen gold come off the boil, I think, year to date. Do you still see value in the gold sector? And then maybe speak to us about your stock picks in the fund.
So, at around about the $4,000 level for gold, my view is that I think gold is supported at this level. We've seen central bank buying come back in the second quarter, and we've seen China activity. The negative on that has been ETF selling, particularly out of the US in March, and more recently China in June. But if you assume that global interest rates aren't necessarily going to gap away, and that inflation will eventually come under control, and I think gold will be supportive in that environment, and gold price should recover. And in that environment, I still remain with Anglo Gold as my top pick. I think it's best positioned. It's got the best capital allocation strategy. It's got a $2 billion buyback. So Anglo Gold would still be my preferred choice, with Goldfields and Harmony thereafter. But we own very little Harmony, and we own a small bit of Goldfields.
We can see there's sort of 4 broad themes in the portfolio if you look at the positioning. Which of these themes has the biggest disconnect between market expectations and reality, do you think?
Sure, that's a difficult question. I think Tencent would be one. I think I mentioned earlier it's trading on a 13 times PE. It's underperformed, I think, by 26% from its March high. So that is one we remain very positive on. The discount, the Naspers process discount, is around about 35 to 40%. So we think that should narrow over time. Process is going to participate in the Delivery Hero sale. That is about $2.3 billion. That will add cash to the $5 billion buyback. So I think that's all positive. And then AB InBev, it's obviously had it's had a good year. It's obviously been helped by the World Cup and people drinking more beer in America and Mexico. So that's one we still like. We still think there's upside. We did purely on share price performance. We actually did sell a little bit of stock, but it's still one of our preferred choices. And then I think one worth highlighting is Discovery. Discovery had a very good run during the year since we bought it in the last 18 months, and we've decided to exit that position. It's reached our assessment of what we believe fair value, and we've bought Outsurance in its place. We think that's a quality compounder. We like their prospects in Australia, and obviously Ireland is in their J curve. It's on a 19-20 times PE with good growth prospects, and it actually has a dividend yield of about 4%. So that's one we like. I've mentioned the banks. We pretty much added across the board FirstRand, ABSA, and Capitec, and we reduced our Standard Bank position purely on valuation grounds to 0. And then I guess the key one in the pure SA Inc. bucket would be Foschini. After some soul searching and the recent underperformance, and obviously the heightened risks given the threat of high interest rates on the local consumer, and to some extent in Australia, we came to the view that we had similar upside in Foschini as we did in Mr. Price. Mr. Price, our view was that the NKD impact of that acquisition, the market had overreacted to that, and given our view that our conviction level in both our target price and in the management turnaround was higher for Mr. Price over Foschini, we decided to actually exit Foschini and double up on our Mr. Price position. So that was something we've done in the first and second quarter, and then we've been adding to Clicks, probably a little bit early on that, but we think that the derating concerns around market share losses to a competitor are overdone. And I won't go into the resources. I think we've discussed those.
Thanks, Mike. Maybe just to end off sort of the broad balance between, very attractive SA Inc. and, let's call it maybe safety in the global dual listed exposures. How are you balancing that to in the overall portfolio?
Listen, we certainly not putting all our eggs in one basket, and you could see from that earlier slide where we show the 4 baskets, we are spread across all those baskets. And again, it's based on our sort of bottom-up fundamental valuation in terms of stock picking, and we think we've got a good mix across banks, across global consumer, across commodities, and our bespoke sort of SA Inc. bucket. So yeah, we think we are pretty well positioned for the next year.
On that note, we'll leave it there. Thanks so much for your time today, Mike.
Thank you, Monsieur. Appreciate it. Cheers.